Hello, everyone, and welcome to the Inside ETFs weekly webinar. My name is Matt Hogan, and I'm the CEO of Inside ETFs and your host for today's webinar. In today's show, a big question: what happens when volatility returns? New approaches to profiting from the inevitable. In September, the CBOE Volatility Index, or VIX, hit its lowest level in a generation. Even today, the index hovers around 11, near record lows. And in this quiet market of ever higher highs, it's easy to get complacent, but we do so at our peril. If there's one thing that's certain, it's that today's low volatility environment won't last forever. And when the turn comes, those who have been reaching for the stars may find that it's a long, long way back down to earth. In today's show, we'll ask what's causing the current low volatility environment and how long can it persist? Could we gap down if the low volatility trade unwinds? And what strategies can we employ today to protect our portfolios against or even profit from downside risk? Fortunately, joining with me to talk about this are two true experts in the field. Chris Hausman is Director of Risk Management and Chief Technical Strategist for Swan Global Investments, which has put up spectacularly steady returns over a many-year cycle. Chris focuses on risk management of the defined risk strategy investments and positions, monitoring risk across all of Swan's portfolios and preparing stress tests, risk assessment reports, and contributing strategic decision-making at the investment management team. So he's perfectly positioned to talk about managing risk. Chris, welcome to the show.
Thanks, Mac. Appreciate it.
Also joining us is Ben Levine. Ben serves as the CIO and sits on the Executive Management and Investment Committees at 3D. Ben works with 3D's investment committee to refine and enhance the investment architecture underlying their ETF-managed portfolios used in the firm's wealth management and retirement programs. He also helps investment advisors and clients understand current market developments that are driving risk and return. And he speaks about risk more eloquently than almost any financial advisor I know. So, Ben, thanks for joining us today.
Good to have you. Thank you.
All right, we're going to kick things off by allowing each of our speakers to present a little bit about their company, their business, and their strategies. I know each of you prepared a few slides, so I'm going to hand things over first to Chris to walk through Swan Global and your approach to managing risk in investor portfolios. Take it away.
Great. Thank you, Matt. Swan Global Investments is an asset management firm founded in 1997 with a unique idea in mind: to solve the major fundamental problem with investing, managing bear market risk. To us, that means losing as little money as possible in down markets and participating well in up markets. Everything we do, from our investment philosophy to our process and investment decisions, is to serve the best interests of long-term investors in a way that Wall Street hasn't. The foundation of our investment approach is a few simple yet powerful core beliefs. We believe equity markets generally go up over time and that investors need to remain invested to participate in that growth. We also believe that severe losses during bear markets may derail investors. By definition, market risk or systematic risk cannot be diversified away, but it can be hedged. We believe modern portfolio theory and diversification by asset allocation alone are insufficient. In addition, we believe market timing and stock selection are difficult to execute successfully to consistently outperform the market. Investors need growth to achieve their goals, so we are passively invested using ETFs to capture growth in equity markets over time. Meanwhile, we know how important it is for investors to avoid big losses, so we are always directly addressing market risk by using options to hedge against major losses. From an investment process standpoint, the defined risk strategy is pretty simple. First, approximately 85 to 90% of the portfolio is always passively invested in an underlying equity position, usually in an index-based ETF or similar vehicle. Second, we remain always hedged by investing the remaining 10 to 15% to buy a long-dated put option to protect the equity position, and we actively manage that put option to minimize its cost to the portfolio. Third, we are always seeking to capture risk premium by selling market-neutral option strategies. This third portion of the strategy helps to cover the cost of the hedge and generate additional return. The three components can generate returns in up, flat, or down markets. The defined risk strategy is not a risk-on, risk-off approach that attempts to predict that moment in time when it is appropriate to protect. By remaining always hedged, we are not under duress to acquire protection in the midst of a crisis. We believe this is a more prudent approach to investing and hedging. At Swan Global Investments, we refuse to accept that large losses and multi-year recoveries are necessary byproducts of investing. Instead, by actively seeking to not lose big, we believe investors will be better off in the long run. While investors are often told to buy and hold, research shows that investors find it difficult to know when to buy, and in volatile times they find it difficult to hold, often leading investors to buy and fold rather than buy and hold. Our investment philosophy is to buy, hold, and hedge. By remaining always invested and always hedged, our defined risk strategy seeks participation in upside moves in equity markets while reducing volatility and limiting losses in bear markets. The goal is to smooth returns over full market cycles so investors remain invested and on track towards their goals. The defined risk strategy has demonstrated an ability to minimize losses in bear markets, as you can see in this annual returns chart going back to inception of our strategy Select Composite in July 1997. Our strategy seeks consistency of returns and to outperform the 60-40 mix and the S&P 500 over a full market cycle, incorporating both bull and bear markets. Since inception over 20 years ago, we've done just that, as you can see here. At Swan Global Investments, we have one fundamental approach to investing, the defined risk strategy that is distinctly always invested, always hedged. And we apply that strategy to various asset classes and made it available in different investment structures, such as mutual funds, separate accounts, collective investments trusts, and more. If you'd like more information, visit us on our website, swanglobalinvestments.com. Thanks.
All right. Thanks so much, Chris. It is a great approach, one I've grown to appreciate more and more as I've dug into it. So I want to ask a bunch of questions of that. But before we do that, let's bring in Ben Levine for a different approach. Tell me a little bit about how 3D Asset Management tackles this question of risk.
Sure. Well, we look at risk really from a Fama-French framework. Our firm started off as a turnkey asset management provider using DFA or dimensional fund models in partnership with advisors that were looking for outsourced solutions, not just for investment management, but also for more holistic practice management solutions. With the advent of ETFs, starting in roughly, I would say, 2007, the firm rolled out ETF models built on the Fama-French framework of long-term strategic investing, factor-based investing, and global diversification. We serve as more of a strategic long-term based strategist that complements well with tactical strategists, particularly ones like Swan that seek to protect on the downside. But we look at risk really from a long-term framework where we try to manage through the cycle as opposed to managing the volatility within a cycle. And so our really approach in assessing the risk environment is to focus on the risk premiums and how those are being priced in the marketplace. And what I mean by, first some quick disclosures, what I mean by risk premiums is, in essence, what we're trying to do is we're trying to reward smart investor behavior using factors or smart beta. And smart beta is another term for factor, which is another term for risk premium. But the way we look at factor-based investing through the Fama-French lens is that there is a rational economic expectation for why investors are compensated through the capital markets based on certain exposures, whether it's the market itself or beta, or whether it's other risk premiums that academics have identified over time through factors such as small cap, value, dividends, quality, volatility, and momentum. And what we do at 3D is build ETF portfolios using the smart beta products that are out there to get exposures to these various factors while maintaining our overall risk to both equity and in fixed income. Here I list the equity risk premiums and fixed income. There are really two primary ones, credit and term structure or interest rate sensitivity. And we have in the middle capturing traditional active management at a fraction of the cost. All this really means is that really over time, much of the variance of an active manager's relative return versus, say, a cap-weighted benchmark can be sourced to one or more of these factors. And it kind of makes intuitive sense because most active managers will have a size or a small cap bias in their portfolios as they see more alpha opportunities in the small mid-cap area. And with value managers who employ value-driven screens, they're most likely going to have a portfolio that incorporates value and or dividend-based risks. And for growth managers, they'll more likely incorporate momentum, quality type risks as well. So we just believe that you can build a much more efficiently priced portfolio that gives you a lot of the risk premiums that have been delivered through traditional mutual funds. So with that as a backdrop, what we wanted to do quickly was just provide what we believe is a kind of a current assessment of the risk premiums in conjunction with our discussion about the volatility environment, or in particular the low volatility environment. I don't know, I'm sure listeners have either read on ETF.com or on other periodicals about the low volatility environment that we're in right now. And really that's just a reflection of how narrow risk premiums across global markets have been priced. If you think about global equity price to earnings multiples, or PE multiples, for a moment, that in a way can be viewed as a risk premium. How much risk you're willing to, how much return you're willing to bear to get exposure to the markets. And when you invert the PE, it turns it into an earnings yield, which can be roughly then measured against what risk-free assets such as treasuries offers you. And so if 10-year treasuries are about 2.4% right now, and you have global forward earnings multiples of 18 to 19 for the S&P, that roughly translates into a 5%-ish type earnings yield, and then investors have to ask themselves whether a 3% spread above the risk-free treasury is enough to compensate them for that risk. What I show here in this chart are the PEs of the S&P 500, MSCI EAFE, which is an International Developed Markets Index, and the Emerging Markets Index, which is at the bottom. And I track those against the earnings projections that are made over time. And what I want to just highlight here is that markets don't advance in a vacuum. In other words, risk premiums don't compress just because investors have a general appetite for taking on risk. They're following the fundamental conditions of the markets themselves. And if earnings are going up, then markets are going to advance. It's just a question of how much you're willing to pay for that earnings advance. And so you can see that the green lines indicate, what I would say are the earnings recoveries. And what it really means is that the reason why, for instance, we're seeing international markets recover this year and outperform the U.S. is because the earnings picture has improved. Whereas prior to that, the only market that really saw meaningful earnings improvement was in the U.S. So we're starting to see not just U.S. risk premiums be compressed, but we're also seeing it globally as well. And in terms of factor performance, which is another way we look at risk premiums, you can see that risk premium performance has generally been strong across the board. Momentum obviously being the strongest, having outperformed handily the broader market, followed by quality, low volatility, and then the laggards so far this year have been value and high dividend. I would say value and dividend-based strategies are the one areas where risk-based premiums haven't been rewarded, but they've still performed positively nonetheless, and their historical valuations aren't that out of line with the broader market. On the fixed income side, credit risk premiums have also compressed to very low levels. And if you look at the bottom chart, and the red line indicates the high yield spread versus risk-free treasuries as measured by Bloomberg, and it's pretty compressed at about 3.7%. And Moody's is projecting a default rate over the next 12 months of about 2.5%. So really investors are only being compensated for anywhere from 1.2 to 1.5% for taking on high yield credit risk. And so again, it's not done in a vacuum because as earnings have improved for the broader market, so have the cash flow profiles. And investors are more comfortable with companies taking on more debt and more leverage and financing that at lower rates. So the big question I think investors should not only ask, am I comfortable investing in this current low volatility environment, but am I currently comfortable also with investing the various risk premiums that are afforded across the global markets? And that is, those are our initial comments on 3D. As I said, if you want to learn anything more about our company, you can visit our website at 3dadvisor.com.
Awesome. Thank you so much, Ben. Now, two very different approaches. We're going to delve into the pros and cons of each. But I want to start first really on the big picture. And I guess I'd bring you back, Chris. Talk about the low volatility environment. What is causing this incredibly persistent low volatility, and how long, from your perspective, do you think it can persist? What will mark its end?
Well, it comes, bottom line is lack of sell-offs. I mean, we're nearly a year without a 5% sell-off. Our largest sell-off this year has been just shy of 3%. So, when we study risk premium in our strategies and harvesting that risk premium, which many people are comfortable with, that creates low realized volatility. As was mentioned, volatility is low across all assets. Not only is it low across all assets, but it's globally low. And that's consistent with economic growth, which in turn contributes to this low volatility in the global markets. Diving in a little bit deeper, if you look at the Standard & Poor's, pairwise correlation in sectors is lower than it has been in recent years. Stock-by-stock correlation is even lower right now than back in 2005, 2007, which was another low volatility period, which many people were not around to trade or manage positions or just simply forgot about. In other words, stock dispersion is higher while index moves are lower. Now, that doesn't necessarily translate directly to a bad or poor risk premium environment. A lot of short premium strategies have been doing very well this past year, even though we've been in a low absolute VIX, if you will. We've just been in a lower realized volatility, and therefore it's translating into profitable strategies. And addressing how long could it last? Yeah. Go ahead.
Yeah, no, go ahead. No, I want to hear. I want to hear how long it can last. That's a critical part.
Yeah, I was just going to address. I mean, we've been here before, and that's what I keep reminding people. I mean, there's a lot of stats on an absolute basis that we are as low as back in the 1960s, 1965. As far as a VIX closing above 20, I think we're in the third longest streak, just a little over 270 days. But I want to remind everybody, again, back in 2004, 2006, we had over 550 days where we didn't get a close over a 20. So could it last? Sure. I think low volatility period environments last anywhere from 15 to 16 months. So don't be surprised if it lasts a little bit longer, but it is getting long in the tooth. I think a lot has changed since 2004, 2006 with all the new volatility products that we have to deal with, all the inverse ETNs that are related to the VIX futures, the ETPs that have to rebalance and have this shadow gamma effect. So there are a lot of new things that we have to incorporate in our volatility analysis today as opposed to back in 2005. And just to put things in a little bit more perspective, as far as the low VIX environment that we're at, a 14 VIX a 10 VIX today feels like a 14 VIX back in 2013-15. A 10 VIX today feels like a 16 VIX in 2011, 2012, and a 10 VIX today feels like a 24 VIX in 2009. I think anybody today would be like, holy cow, what's going on with the 24 VIX? But the bottom line, the message I'm trying to convey here is that volatility cycles like all products, like all investments, and there are periods of low volatility and high volatility, but that doesn't translate directly, again, into poor strategies or poor income-producing environments.
Absolutely. Ben, does that line up? I mean, you were sort of arguing that the risk factor environment is pretty normal. So are these concerns over this spooky low volatility environment misplaced? Should we be worried about the impact of volatility ETFs and shadow gamma? Is there any way that this unwinds in a bad way in your experience, or is it pretty much steady as she goes?
Sure. Well, I wouldn't necessarily characterize it as normal, but what we would do is we would try to say, is it rational? Is the current low risk environment rational based on the macro and the market backdrop for how risk is being priced? And I would say that it's rational in the sense that realized volatility has been low. So, volatility being priced into options such as the VIX or being priced into risk premiums reflects the low realized volatility that we've been experiencing. Whether it's rational or not, remains to be seen, because certainly if the cycle were to turn, if earnings were to drop, or if the economic backdrop were to deteriorate, then sure, we're going to see volatility pick up. And in essence, given the low volatility environment right now, in essence, the mousetrap has been very tightly wound such that it doesn't take much to, trip up the trap itself. It doesn't require the mouse to actually step on the trap to trip it, just a kind of a hard knock right next to it. I would also fall on some comments, some recent reports I've read too, is one market deconstruction using a principal components-based risk model, which is a statistical technique to try and derive what are the main systematic influences that can explain the overall market volatility, as opposed to, say, stock-specific volatility. We've seen the share of systematic to stock-specific flip for the first time since the financial crisis. So during the 2000s, which was kind of the nirvana heyday period for active management and stock picking, the overall market volatility could be explained by stock-specific risks. That relationship flipped post-2008 when systematic or macro variance factors could explain most of the market variance, and that was a period very difficult for traditional stock picking. Well, for the first time this year, we've seen that relationship flip back again to stock-specific variance, and that coincides with the low pairwise correlations that we're seeing, and certainly the low volatility environment right now is reflecting not just low overall volatility, but also the low correlations that are bringing down volatility measures. So, is the environment normal? It doesn't feel normal because we haven't really experienced this for quite a while. But is it rational? Based on the conditions right now, certainly say it is. But also with the caveat that not much. It wouldn't take much to disrupt or cause risk to spike, and we got a little hint of that back in August with the North Korea saber rattling and questions over whether tax reform was going to be achieved or healthcare reform was going to pass or not. That caused volatility to spike momentarily in August, but then it came right back down again. So I would just also wrap up too in the past I've made comparisons to the catastrophe risk model environment and how catastrophe risk, such as insuring against hurricanes and so forth, the pricing of that risk has come down quite dramatically up before we saw Harvey and Irma come through. And in essence, just like in equity markets, insurance risk models reflect, the catastrophe experience. And, before this year, we haven't really experienced major hurricane activity since Irene, I think, and that was in 2010 or 11. And then Katrina was the big one before that. So in a way, risk, the way risk is being priced in the environment right now sort of is a rational expectation based on, the risk that has been experienced over the past year.
That's an interesting analogy. There's a lot to unpack in what both of you said, but let's take that idea of catastrophic risk insurance. And let me ask you, Chris. The Swan returns have been incredibly steady. Maybe just briefly overview sort of the carrying costs of applying that options strategy on the equity position, and how you explain to clients to sort of expect to trail the market in bull markets, but to stick through it because they'll benefit so much in the bear market. So tackle that in two pieces.
Sure. So we do apply a long-term hedge, a long-term put to our equity. So it is a true inversely correlated asset where the underlying moves up, your hedge is going to have some type of drag, but then the bonus is when the underlying moves down, then that's going to act as a hedge. That's the whole entire point. So characteristically, that hedge has a drag anywhere from 3 to 4% per year. So we have our equity piece, our hedge component, and then we have our short-term premium component, which is harvesting. It's basically a harvesting risk premium program that tries to pay for that hedge and add incremental return. So I think, difficult periods for the hedge would be what we went through over the last year. We buy the overall portfolio is long volatility, it's long vega. So increases in volatility is something that we want. It's something that we can take advantage of. So over the last year, it has been challenging. The market has been up. We've lost as a function of direction or delta as far as the hedge is concerned, but we've also been hit from volatility declining over the past year. Now, the good news is that volatility, or where you can buy this protection, this longer-term protection, is at 10-year lows, and so that's beneficial for us moving forward because the whole premise is always invested, always hedged, right? As opposed to short-term hedges, one of the problems, even though, again, short-term hedges right now are also cheap, but the problem you have with shorter-term hedges is managing the running cost of that hedge. You may have to manage that cost potentially for many months. So if you do get into this environment that we're kind of talking about, like, well, when is volatility going to increase? If you have shorter-term hedges in place, it may be cost prohibitive down the road to keep entering or keep establishing that sort of hedge. And, hedging helps investors do what? Stay invested, and it shifts their potential distribution of returns. And that's why we've been able to have these returns over a 20-year period. So investors can stay invested longer, and then they ultimately benefit from market upside.
Right. And Ben, on your side, what is the risk protection on your side is just making sure that risk premiums and economic reality are aligned? And then how does the portfolio rotate if you determine there is a disconnect? Like, give me an example.
So in early 2016, we moved to an overweight to international equities and in particular emerging markets. Before that, we were neutral and had been overweight the U.S. in the past, and we benchmark ourselves against global equity benchmarks for our global equity ETF program. And that was just an assessment of the improving macro environment combined with cheap valuations, and it just felt that the risk characteristics at the margin favored the international markets more than the U.S. And arguably, we were a little early on that call, but it wasn't one of those things that we necessarily bet the farm on, just that we felt the risk environment favored international markets more than the U.S. And so that's, those are kind of the exposures that we would adjust at the margin within global equities and within fixed income. But advisors who use our models use it within a traditional asset allocation framework. So our Global 60 product, for instance, is always 60% invested in global equities, 40% in fixed income, and that allocation doesn't change. So really it's more of a strategic asset allocation. And what we would just advise our advisors and our clients is if you feel uncomfortable with the risk environment right now and your time horizon can't afford to ride out any significant volatility measures, the easiest and cheapest thing to do is to reduce your equity ratio or reduce your equity allocation, because market variance is the primary determinant of overall volatility. So if you're not in the market, you're obviously not subjected to the volatility. The next step would be to do what Swan and others do, which is to be able to find the most cost-effective means of hedging or insuring your portfolio against market losses. And we don't engage in any of that kind of downside risk protection in our portfolios. As I said, we're more strategic in our asset allocation. But as I said at the margin, if we feel like risk premiums aren't being priced, regardless of whether we think they're being priced in a rational sense or not, if we just don't feel like we're being properly compensated for the amount of risk that's being priced into the markets, then we'll scale back a little within our portfolios. And another good example is earlier this year we increased the credit quality in our portfolios as both investment grade and high yield spreads had come in. We felt like spreads, although the environment made sense for this spread compression, we just felt like we weren't being as compensated for taking on this kind of risk because, in a sense, credit spread, unlike equity risk, its upside is limited. And so we felt like if the environment was going to improve further, then you were better being compensated for taking on risks within equity than you were, say, in fixed income.
Awesome. All right, we have 1 minute left. I'm going to ask a closing question of Chris because you mentioned it earlier. It's something people ask me a lot. Do you worry about crowding in the short volatility trade? And is there any systemic risk to that unwinding if volatility spikes to 30 overnight?
Well, the space has certainly gotten There's certainly more competition in the space. There's no question about that, especially since 2009, even more so after 2011. So one of the things we point out is that over our 20-year track period, we've been through some very high volatile periods. So the strategy has worked over many and multiple volatility regimes. Is there going to be some type of massive unwind? There very well could be. The shadow effect, the short gamma effect, we see it now since we're at absolute low levels of the VIX. You're going to have high percentage moves, and this forces rebalancing, which is almost creates this feedback loop. So it's something that's part of the landscape today in the environment, the volatility environment that we're currently in. But those moves, if you know how to zig and zag through them, we see them as opportunities to enhance overall returns to our portfolio. So it's something that definitely everybody needs to be cognizant about. I think there are a lot of volatility players that are new to the space and in some way, shape, or form have not been truly tested, via financial crisis back in 2007, 2008, or even the volatility that we experienced in 2011.
Well, it should be interesting. That does take up all our time. Really appreciate it. Chris Hoffman, Director of Risk Management and Chief Technical Strategist for Swan Global Investments. Ben Levine, CIO for 3D Asset Management. I'd encourage you to go to both of their websites. We invited them on here today because they have exceptional track records of navigating risky markets and unique approaches to those. So this is just a taste of what they can do. Please do check them out. Thanks for joining me on the weekly Inside ETFs webinar. We'll be back here in 2 weeks. We're taking next week off for the Thanksgiving holiday, but really appreciate everyone joining us today. Thanks so much. Have a great rest of your week.